There was a time when buying a house in California felt like achieving the ultimate dream, but as we step into 2025, it isn't the mortgage that's draining families, it's the skyrocketing insurance bills. From Malibu's fire-scarred hillsides to the flood-risk neighborhoods surrounding Sacramento, homeowners are now facing annual premiums of $7,000, $10,000, and sometimes climbing past $15,000. To make matters worse, many insurance providers are withdrawing from entire regions, leaving countless residents without any protection at all. In this report, we reveal the 10 California cities where insurance costs are making homeownership nearly impossible to sustain. If you think your mortgage payment is steep, wait until you see what people are forced to pay just to keep their homes insured. Subscribe to Discover the Cities for sharp, in-depth housing investigations you won't see anywhere else. Now, let's dive in. Number 10. Santa Clarita. Santa Clarita has long carried the reputation of being one of Southern California's most family-friendly cities, known for its peaceful canyons, strong school districts, and steady growth just north of Los Angeles. But heading into 2025, that picture-perfect suburban lifestyle is being pushed to its breaking point. The statewide insurance meltdown hasn't just reached this area, it has settled in, turning the foothills into one of the newest hotspots of the crisis. Homeowners in Santa Clarita are now staring at insurance bills that average more than $8,000 per year, and even paying that doesn't guarantee you can stay insured. Major providers have stepped away from many high-risk zones: Canyon Country, Stevenson Ranch, Saugus, leaving entire neighborhoods scrambling. Thousands of homeowners have been pushed onto California's FAIR Plan, the bare-bones, high-cost option meant only for emergencies. The reason is impossible to ignore. Repeated wildfire seasons have fundamentally changed how insurers view the entire region. Santa Ana wind-driven fires have crept dangerously close to communities that once felt untouchable. Even homeowners who invested in metal roofing, defensible space, and upgraded fire-resistant construction find themselves labeled high risk solely because of where they live. For retirees and middle-income families, the financial equation simply doesn't add up anymore. Some longtime residents are putting "for sale" signs up after decades in the same home, unable to withstand another brutal renewal notice. Others are taking a risky gamble by dropping insurance altogether, praying the next wildfire won't break out near their block. The contrast is heartbreaking. Santa Clarita still has those golden hills at dusk, the weekend crowds strolling along Main Street in Old Town Newhall, and the quiet charm that once symbolized the California dream. But beneath that peaceful exterior, the anxiety is real and growing, because a single insurance bill now has the power to unravel everything people have worked their whole lives to build. Number 9. San Diego. For years, San Diego represented the very heart of the California dream: steady sunshine, a sense of safety, and the belief that anyone could build a good life there. From the dramatic cliffs of La Jolla to the calm beaches of Coronado, the region held a kind of magic that drew in families and retirees alike. People imagined raising children near the ocean or spending their later years listening to waves instead of city noise. But in 2025, that idyllic picture is starting to fracture. A city once defined by effortless beauty is now being overwhelmed by an insurance disaster unlike anything in its history. Homeowners throughout San Diego County are watching their premiums skyrocket, with average annual costs climbing beyond $9,000. In certain coastal towns, that number jumps to $15,000 or higher. Insurance companies, increasingly concerned about wildfire danger in the inland foothills and major flood risks along the coast, are retreating from the market. Even well-designed properties built with top-tier safety features are being denied renewals or slapped with increases so steep that coverage becomes unattainable. Because of this, the California FAIR Plan, a program originally intended as a temporary safety net, has become the only option for thousands of residents. But this plan offers only basic protection and excludes essentials like liability and theft coverage. For households in communities like Poway, Santee, and Escondido, where property taxes continue rising and wages remain flat, this extra financial pressure is pushing many budgets to the edge. The crisis isn't only affecting homeowners. Developers are rapidly pulling back as well. New construction projects are being paused or canceled because buyers refuse to commit without reasonable insurance options, and banks are rejecting loans for properties located in high-risk zones. As these issues ripple through the region, real estate values are beginning to dip, and small landlords face the choice of raising rents or exiting the market entirely. For middle-class families, the situation goes beyond dollars and cents. It raises a painful question. Does the California dream still exist? Longtime residents who built their entire lives in San Diego are finding themselves priced out not by down payments or mortgages, but by the cost of simply safeguarding their homes. Number 8. Sacramento. Sacramento used to be California's middle ground, the place where people went when they wanted something more affordable than San Francisco and far less chaotic than Los Angeles, while still staying close to both. For years, it struck the perfect balance. But by 2025, that balance has collapsed. The city's once manageable cost of living is now being overwhelmed by soaring insurance premiums, newly expanded flood risk zones, and steadily rising property taxes. Sitting at the junction of the Sacramento and American rivers, the region has always accepted a certain level of flood danger. But recent FEMA updates have completely reshaped the map. Entire neighborhoods that had never experienced a single puddle in their streets are suddenly labeled high risk. And with that new label comes mandatory flood insurance, expensive flood insurance. Premiums have exploded. Many residents are now paying over $7,500 a year just to insure their homes. Families in South Natomas, Pocket Greenhaven, and the communities lining the American River are being hit the hardest. Their overall cost of homeownership has jumped by several $1,000s annually, and that's before they even factor in mortgages, utilities, or maintenance. The ripple effects are everywhere. Developers are pausing new projects. Potential buyers are stepping back, unsure whether they can afford the long-term cost of ownership. Meanwhile, long-established homeowners feel cornered as property taxes rise in step with their insurance renewals. Sacramento once marketed itself as the budget-friendly alternative to the Bay Area. Today, many residents say it feels just as expensive without the high salaries that justified those costs in San Francisco or Silicon Valley. The city's massive levees and flood walls still stand strong, but the financial pressure climbing behind them is becoming far more dangerous than the water they're meant to hold back. Sacramento continues to shine. On the surface, shady tree-lined neighborhoods, the capital's silhouette, and the slow, steady rhythm of daily life. Yet beneath that calm exterior, the rising costs are slowly eroding the very dream that once defined the city. Number 7. Monterey County. Monterey County has long been considered one of California's true treasures, a remarkable stretch of coastline where dramatic cliffs drop into the Pacific, vineyards roll across the hills, and small towns carry a charm that feels almost untouched by time. From the iconic cypress-lined beaches of Carmel to the rich agricultural fields around Salinas, the region once felt like a perfect marriage of natural beauty and economic stability. But by 2025, that balance is unraveling. A full-scale insurance crisis is reshaping life along the Central Coast, and nowhere is the impact more visible than here. Homeowners throughout Monterey County are now staring down annual premiums that average more than $11,000, with certain coastal areas easily surpassing $15,000. And the explanation behind these skyrocketing prices is painfully straightforward. Insurers no longer want the exposure. With wildfire danger creeping through the inland mountains and coastal neighborhoods increasingly vulnerable to rising sea levels, major insurance companies have pulled back or abandoned the area entirely. What most residents are left with is the California Fair Plan, a bare-bones, last-resort option that offers minimal coverage at an extremely high cost. Even households that have invested heavily in safety aren't being rewarded. In communities like Big Sur and Carmel Highlands, people who built fire-resistant homes, upgraded roofing, or elevated foundations to reduce flood risk are still deemed high risk purely because of their location. The message is clear. The system isn't evaluating your preparation, it's penalizing your zip code. This pressure is forcing longtime families, many of whom have lived on the Central Coast for generations, to reconsider whether they can afford to stay. At the same time, potential buyers are backing away, afraid of locking themselves into lifelong premium payments that rival a second mortgage. The disruption doesn't stop at homeowners. The entire local economy is feeling the shock. Builders have slowed or halted planned developments because buyers can't find reasonably priced insurance. Homes are sitting on the market longer than ever. Even the luxury real estate segments, areas like Pebble Beach and Pacific Grove, which once attracted constant demand, are seeing fewer offers as ownership costs surge. And while wealthy buyers might hesitate, the people suffering most are middle-income households and agricultural workers in places like Salinas and Marina. For them, insurance premiums are now competing with essentials, rent, groceries, and transportation, pushing budgets to the breaking point. Number 6. Santa Cruz. Santa Cruz used to represent the pure spirit of life on the California coast. Sunrise, surf sessions, towering redwoods, casting long shadows at dusk, and a sense of peace that seemed woven into the rhythm of the Pacific. But by 2025, the cost of living in this coastal haven has taken a dramatic turn. The price of maintaining that tranquility now comes with some of the highest insurance premiums anywhere on California's shoreline, with average annual costs soaring past $10,000. This surge isn't the result of a single issue, it's a perfect storm of risks. Homes perched along fragile bluffs face growing threats from coastal erosion. Wildfire danger steadily pushes down from the Santa Cruz Mountains every summer. And deep underground, the region's well-known earthquake risk keeps insurance companies on edge. What was once a peaceful retreat is now viewed by insurers as a prime example of how climate and geological hazards collide. Communities such as Bonnie, Dune, Felton, and Scotts Valley have watched their premiums double in just a couple of years. Even homeowners who have done everything right, installing fire-resistant materials, clearing brush, reinforcing structures, are still classified as high risk. Insurers aren't responding to how well a house is built. They are responding to the volatility of the region as a whole. As major companies scale back or leave the area outright, thousands of residents are being pushed onto the state-run FAIR plan. That policy is designed as a last resort: less coverage, fewer protections, and a price tag that continues to climb. Longtime locals who once paid manageable premiums are now making painful decisions, selling longtime family homes, refinancing to cover skyrocketing costs, or choosing to live without insurance entirely and hoping disaster never strikes. For new buyers, the situation is even worse. The dream of buying a home in Santa Cruz often collapses before it begins. Monthly, insurance payments can now exceed property taxes, and in some cases, they rival a second mortgage. Real estate deals fall apart daily because banks require insurance that simply isn't available. Local leaders continue to push for legislative fixes, but reforms move slower than the pace of rising risk. Every season brings another challenge: fresh fires, violent coastal storms, new rounds of non-renewals, and residents are losing faith in a system that was supposed to protect them. The frustration is growing as fast as the coastline is receding, and yet, Santa Cruz still captivates. The boardwalk lights gleam across Monterey Bay, waves crash beneath the cliffs like they always have. Downtown remains alive, with artists, students, and the energy of a community that refuses to lose its identity. But behind the postcard-perfect image lies a sobering reality. People here aren't just asking whether they can afford to buy a home anymore. They're asking whether they can afford to keep it safe. Number 5. Oakland. Oakland's skyline stretches confidently across the bay, a city long celebrated for its grit, its creativity, and its ability to reinvent itself. But in 2025, homeowners here are facing a challenge very different from the wildfires and climate threats hitting other parts of California. This time, the fight is happening inside the city, an insurance crisis created by a complicated mix of urban risks that are pushing costs to levels few expected. What's driving this? A combination of earthquake vulnerability, aging water systems, rising theft and vandalism claims, and an uptick in property damage tied to deteriorating infrastructure. Together, these pressures have sent premiums across Oakland skyrocketing. Neighborhoods such as East Oakland, Rock Ridge, and the Oakland Hills have been hit especially hard. For many residents, annual insurance costs now sit between $7,000 and $9,000. And that's just for basic coverage. Earthquake insurance, which most lenders require on top of homeowners policies, adds another $3,000 to $5,000 each year. For countless families, the total bill rivals a second mortgage payment, turning what once felt like security into a financial burden that's becoming harder to carry. The effects are rippling across the city. Longtime homeowners are walking away from older properties they can no longer afford to insure or repair. Others are taking on enormous risk, choosing to live without coverage in a place where a burst pipe, a small quake, or an electrical short could erase a lifetime of savings in a single moment. Developers have started delaying projects. Banks are raising their lending standards. And would-be buyers who once saw Oakland as the more affordable alternative to San Francisco are hesitating. Insurance companies blame the surge in claims and the strain caused by an aging city infrastructure. Residents point to policy failures and years of neglected maintenance. But no matter whom you ask, the outcome is identical. Premiums climbing, systems faltering, and a widening gap between those who can afford the new costs of homeownership and those already falling behind. And still, Oakland's spirit hasn't dimmed. The murals continue to splash color across the streets. Local markets and festivals still pulse with music, food, and community. Yet beneath that vibrancy, a quiet anxiety lingers. Homeowners are doing the math, wondering how long they can stay afloat in a city that once symbolized opportunity but now requires constant endurance. Number 4. Palm Springs. Palm Springs has never been just a dot on the map. For generations, it felt like a fantasy brought to life, a desert oasis where mid-century modern homes gleamed beneath endless sun, and the wealthy escaped the noise of Los Angeles for quiet mornings and poolside afternoons. But in 2025, that desert dream is carrying a weight it never had before. What used to be a simple part of homeownership insurance has become the very thing threatening the lifestyle Palm Springs is known for. The cost surge is astonishing. Across Palm Springs and the greater Coachella Valley, homeowners now face yearly premiums averaging $11,000, with certain mountain-adjacent neighborhoods seeing policies climb beyond $15,000. These are not careless owners. Many have invested in metal roofs, sophisticated fire suppression upgrades, and defensible space. But none of that matters. Insurers are labeling entire zones as high risk simply because of geography, where wildfire danger blends with flash flood exposure. Some insurance providers have stopped accepting new customers entirely. Others remain, but demand premiums so outrageous that securing a policy feels more like winning a lottery than purchasing coverage. As a result, the entire housing ecosystem is cracking. Home sales that once closed effortlessly are falling apart. Investors who relied on short-term rentals are abandoning properties. Banks refuse to release funds until buyers prove they can obtain binding coverage, something that is no longer guaranteed. Developers who spent years turning the desert into a showcase of modern design are hitting pause. Projects meant to bring new luxury homes to the valley are being scaled back or canceled altogether because buyers cannot shoulder the new insurance burden. It is a strange twist of fate. Palm Springs was built on the idea of ease, slow mornings, quiet nights, and the sense that life here moved at a softer, gentler pace. Now residents find themselves doing annual financial triage, asking whether they can afford to keep their policies, or whether they are willing to take the enormous gamble of living uninsured in one of California's most climate-exposed landscapes. Yet, despite the worry, Palm Springs retains the charm that made it iconic. The palm trees still sway against a flawless sky. The pools still sparkle like sheets of glass. And the sunsets continue to ignite the desert in shades of amber and red. But behind this postcard perfection, anxiety is spreading. The sunshine has not dimmed, but the shadow of financial risk has grown long. Number 3. Los Angeles. Los Angeles has long symbolized boundless opportunity, the place where ambition meets ocean air, and people come to transform their lives under endless blue skies. But in 2025, even the city that thrives on reinvention is facing a challenge it cannot charm or outgrow. The insurance crisis has taken root here, and it is spreading across every neighborhood, canyon, and coastline. In Topanga Canyon, the threat of wildfire has pushed premiums to levels locals have never seen before. Over in Echo Park and Silver Lake, the constant worry of hillside erosion is forcing insurers to reassess risk, sending rates higher each year. Meanwhile, communities from South Central to Koreatown are struggling with the added burden of earthquake risk and crumbling infrastructure, a combination that drives prices even further beyond reach. The typical homeowner in Los Angeles is now staring at insurance bills that hover near $10,000 annually, with certain zip codes routinely exceeding $14,000. When earthquake policies, liability coverage, and rental protection are added on, many residents are paying what feels like an entire second mortgage simply to maintain coverage. Even LA's most iconic luxury neighborhoods, Brentwood, Beverly Hills, Pacific Palisades, are no longer insulated from the upheaval. Entire districts are being classified as high-risk zones, causing major insurers to pull back or stop issuing new policies altogether. Renewal notices, once routine paperwork, now arrive like warnings. For many homeowners, the only remaining option is the state-operated FAIR Plan, a costly alternative with minimal protection. This insurance shakeup is altering the entire real estate landscape. Buyers are pausing, uncertain whether they can afford long-term coverage. Sellers are holding off, worried that deals will collapse. Developers, unable to secure insurance commitments required by lenders, are shelving projects and slowing construction across the county. One of America's hottest housing markets is suddenly cooling under the weight of risk and doubt. Yet LA still shines. The skyline glitters as the sun dips behind the hills, the beaches pulse with energy, and the city's spirit of reinvention is as persistent as ever. But beneath that beauty lies mounting fragility. Los Angeles is discovering that even a city built on dreams is vulnerable when the economics of risk begin to tilt. Number 2. Malibu. Malibu has long stood as the ultimate postcard vision of California, glassy waves rolling toward untouched sand, sunsets dripping gold into the Pacific, and hillside homes perched so perfectly they look almost unreal. But by 2025, even this iconic strip of coastline is discovering that paradise comes with a cost few can keep up with. The price of risk has finally caught up to the dream. After back-to-back wildfire disasters, Woolsey, Decker Canyon, and countless smaller blazes, Malibu's insurance system has begun to unravel. Most major insurers have abandoned the region altogether, unwilling to shoulder the mounting volatility. The companies that remain charge staggering rates, $18,000 to $25,000 a year for the most basic homeowners policy. And even with that, approval is never guaranteed. Real estate agents now include a chilling line in high-end listings: buyer must confirm insurance eligibility. That one sentence is enough to freeze multi-million-dollar negotiations in their tracks. The effects are visible everywhere. Oceanfront properties along the Pacific Coast Highway that once sold instantly, often above asking price, now linger on the market for months. Even wealthy buyers, people who could once shrug off expensive coverage, are hesitating. For each person still determined to live in Malibu, several more quietly walk away, unwilling to take on the unpredictable financial burden. Rebuilt homes offer little reassurance. Houses reinforced with steel roofs, fire-resistant siding, concrete surrounds, and underground power lines are still ranked as high risk simply because of their location. Insurance algorithms do not admire the cliffs or the turquoise water. They calculate danger. To insurers, Malibu isn't a coastal sanctuary, it is a probability chart full of red flags. Not everyone living here owns a clifftop mansion. Inland neighborhoods like Point Dume and Malibu Park are home to retirees, teachers, small business owners, people who built their lives in the quieter pockets of the city. These residents have been hit the hardest. Premiums have doubled, even tripled, in just a few years. Some households have made the painful decision to drop insurance entirely and accept the possibility of losing their homes because the alternative is financially impossible. And still, Malibu remains stunning. The ocean roars with the same force as always. The air carries the familiar mix of salt and wild sage. The evening sky still erupts in brilliant orange and violet. The beauty has not faded, but the sense of security has. Number 1. Sonoma. Sonoma has long been the quiet heartbeat of Northern California, lush vineyards stretching to the horizon, sun-drenched hills rolling like waves, and a lifestyle built around patience, craft, and community. For years, families, winemakers, and retirees settled here believing they had found the perfect blend of beauty and stability. But by 2025, that sense of calm has been replaced by a financial upheaval the county has never seen before. This time, the crisis is not a wildfire roaring through the valleys. It is the insurance system itself. The fires of the past reshaped the land. Now, the fallout from the insurance market is reshaping the future. Annual premiums in Sonoma County have climbed past $10,000 on average, and even paying that much no longer ensures that homeowners can actually get coverage. Major insurance companies have pulled back or exited completely, pointing to worsening fire danger and skyrocketing reinsurance expenses. Families who rebuilt after the Tubbs fire and the Kincaid fire, people who endured loss, followed every building code, and invested in safety upgrades, are now confronting a devastating truth. They may not be able to afford to protect the homes they fought so hard to keep. Thousands of residents have been pushed onto California's FAIR Plan, the bare-bones, last resort option that offers minimal coverage at an enormous cost. It excludes basics like theft and liability, forcing homeowners to stack multiple supplemental policies just to meet lender requirements. For many middle-class families, retirees on fixed incomes, and small vineyard operators, the combined price of those policies now exceeds what they pay for both their mortgage and property taxes. The housing market is straining under the pressure. Buyers back out the moment they see the insurance quotes, sellers slash asking prices, or leave the county in search of affordability. Local banks have tightened their lending standards, and many will not approve a mortgage without full proof of coverage, something that grows harder to obtain with each passing month. And yet, Sonoma remains as stunning as ever. The vineyards still shine in the late-day light. The breeze still carries the scent of lavender, wine grapes, and warm earth. The charm of its small towns, Healdsburg, Sonoma, Glen Ellen, still feels timeless. But beneath that postcard, beauty is a growing anxiety. In 2025, owning a home here has become less about luxury and far more about endurance.